Welcome back to the deep dive. For decades, public storage, with those familiar orange roofs dotting every highway, has been relegated to this mental category of a boring passive landlord.
Just collecting rent.
Exactly. People just see it as simple real estate collecting rent, period. But if that's still your view, you are missing, I think, the most important structural shift in this entire business.
Absolutely. When we set out on our research project, our main objective was to conduct a really deep qualitative assessment to tear away that conventional image. We wanted to discover the corporation's true transformed identity.
So looking beyond just the square footage.
Far beyond that, we wanted to get deep into the operational engine.
And what we discovered really surprised us. Our conclusion is that public storage is no longer just an asset owner. It has matured into this sophisticated technology-enabled logistics platform.
A mechanism for personalized inventory management, really.
We concluded the company is so structurally robust that we titled our research, The Fortress in the Fire.
And we should probably unpack that fortress metaphor. It all starts with the sheer magnitude of their operation, which we started calling the industrialization of the American attic.
I love that phrase.
With over 3,300 facilities and, about 2 million customers, the company achieved a scale that allows for what we call efficiency arbitrage.
And efficiency arbitrage, just to be clear, is the ability to decouple their own potential operating margin from the industry's fragmented kind of low-tech average.
Exactly. They're playing a fundamentally different game now.
A different game.
Precisely. And that scale creates one of the most remarkable competitive barriers we identified. The cognitive moat, that iconic orange brand, it's everywhere.
You can't miss it.
You can't. And this physical ubiquity acts as a colossal, non-stop billboard network across every single major metropolitan area.
Okay, it's not just signage, it's an active strategic asset. How does that really translate into financial value?
In a sector that's pretty commoditized, that ubiquity significantly lowers the customer acquisition cost, or CAC, relative to competitors. Think about it. When you need storage...
You don't need a search engine.
No. You just need to spot the orange roof. Our research showed that the company is effectively operating, in part, as a media company, using its own real estate footprint as the ultimate hedge against rising digital ad costs.
That's a powerful insight. But the real game changer we tracked is their operational shift, what their management calls the property of tomorrow concept.
Right. This is the aggressive move toward facilities that are either unmanned or only lightly manned.
So getting people out of the equation.
As much as possible. The shift relies on digital keypads, app-based access, remote customer service.
Yeah.
It all allows for this zero-touch move-in process. This is the key to preserving their margins.
How?
Because we discovered a digital lease costs effectively zero in labor hours. By severing that historical link between the number of facilities they own and the required headcount, they dramatically improve margins. It's critical in an inflationary labor market.
Okay, now let's zoom out a bit to the demand drivers, because our analysis revealed a fascinating shift in the sociology of storage. We all know the historical drivers, the 4Ds.
Death, divorce, dislocation, and downsizing.
Yeah, those classic event-driven and often temporary needs.
But our findings show external storage has become something else. It's now a permanent lifestyle enabler for the middle class.
As urban housing just gets smaller and denser.
Exactly. People are effectively renting the square footage their small apartment or house simply doesn't have. This shift from event-driven usage to lifestyle-driven usage dramatically lengthens the average tenant duration.
Which means the lifetime value of each customer, how much money they generate over that rental relationship, it just goes way up. They aren't planning to leave.
It's a structural tailwind for their cash flow. It's sticky.
Okay, let's look at the financial architecture of this Fortress Section 2. We analyzed the industry structure, and what we found is what we define as a distinct barbell structure.
At the top, you have this massive consolidation, the duopoly. But at the bottom, you have persistent, highly inefficient fragmentation. We're talking 70 to 75% of the market is still run by small mom-and-pop operators.
And understanding the two giants at the top, public storage and extra space storage, is vital. Their business models are fundamentally different.
Completely different. PSA is the owner-operator. Their focus is on asset appreciation, owning the vast majority of the real estate, and crucially, maintaining what we termed the fortress balance sheet.
Very low leverage, high credit ratings.
A-rated. They fund their expansion largely through preferred equity.
And on the flip side, you've got extra space storage, or EXR. They operate much more like an asset manager.
Yeah, they're relying heavily on third-party management, 3PM, and joint ventures. They're focused on generating fees, not necessarily owning the dirt.
What was our finding there? Which model is better?
Our finding is that PSA's asset-heavy model is structurally superior, especially in the higher-for-longer interest rate environment we project for the coming years, say 2025 and 2026.
Why is that?
Because the owner, PSA, captures that inflation-hedged appreciation inherent in the underlying real estate. The manager, EXR, on the other hand, faces margin compression as those third-party owners eventually demand lower management fees.
And this is where that efficiency arbitrage we talked about earlier becomes this massive financial weapon, the acquisition arbitrage. We found that this fragmented long tail of small operators is the primary engine for PSA's external growth.
It is. Many of these small operators, they utilized floating rate debt during the boom years of 2020 to 2022.
When money was cheap.
Exactly. Now they face a significant refinancing wall with rates much, much higher. Public storage acts as the essential buyer of last resort in these situations.
But it's the immediate boost to the bottom line, the accretion potential, that's truly remarkable. We observed that they might acquire a facility running at a traditional labor-intensive 60% operating margin.
Which is pretty typical for a small operator.
And then what happens?
They immediately plug that new asset into their existing digital unmanned operational platform. And by doing that, they instantly lift that margin to 75% or even 80%.
Wow.
Imagine automating an old business and seeing profits jump by a third overnight just by flipping a switch. That operational efficiency translates directly into huge, immediate cash flow gains. It just compounds their edge with every single purchase.
That structural advantage leads us directly into how they manage pricing, which is our third section. We looked past all the market noise about street rates.
The bait?
Yeah, the low advertised price for new customers, which has admittedly been a little soft lately. We focused instead on RevPAF, the realized revenue per available foot.
RevPAF is the actual economics, the money they really collect after all the discounts and adjustments. We determined that public storage is the undisputed master of dynamic pricing, using a strategy known internally as ECRI.
ECRI.
Existing customer rate increase.
Or as we called it, the lazy tax.
That's exactly what it is. They lure you in with a low street rate, but once your stuff is locked up in that unit, they aggressively raise rents, often between 15 and 30% after you've been there for maybe 3 to 6 months.
And they can do that because it's just a huge pain to move all your stuff again.
It's pure inertia. And we found they utilize proprietary data from their 2 million customers to model price elasticity at an extremely granular zip code level. It's all about optimizing the extraction of that lazy tax.
This high profitability is protected by another crucial upcoming structural tailwind, what we're calling the supply vacuum. There was some market concern about the construction pipeline peaking in late 2025, but our nuanced reading of the industry data, it revealed a totally different story.
It did. We found that new project starts, so the decision to begin building plummeted by nearly 20% year over year.
Why?
High construction costs and just really difficult financing. And since facilities take 18 to 24 months to deliver, that drop-in starts today absolutely guarantees a shortage of new supply in 2027.
A guaranteed shortage. So that means less competition down the street in the near future, giving the incumbent, the fortress, massive pricing power once this current construction wave passes.
And the management execution just validates the entire thesis. They are maintaining nearly 80% direct net operating income margins, even during a period of high inflation. It proves the unmanned efficiency strategy is working.
And you can't forget the solar initiative.
Right. Across over 1,100 properties, it's a really smart structural hedge against rising utility costs.
Okay, so we've established the strength of the fortress, but now let's talk about the fire burning around it. Section 4. We identified the single most critical near-term headwind, what we termed the LA anchor.
This is a temporary regulatory issue. California Penal Code Section 396 prohibits rent increases exceeding 10% after a state of emergency is declared.
Which happens a lot in California with wildfires and storms.
Right. So due to extensions of these declarations in 2025, this cap was imposed in their single largest and most profitable market, LA County.
And it created a massive but temporary drag. Management quantified this impact very clearly for 2025. It's a direct 23 cents per share hit in lost core FFO.
Funds from operations.
Right. And the issue is that the market is pricing this temporary policy friction as if it were a permanent impairment to their earnings capacity.
But we see the thaw coming. Several powerful tailwinds are starting to coalesce. First, The demographic reality, the silver tsunami.
This is the aging of the baby boomer generation. As they downsize from these large family homes, the emotional process of parting with a lifetime of possessions creates what we call the storage compromise.
I like that.
Instead of selling everything, they just rent a space for those sentimental items.
And this transition drives long-duration, permanent, annuity-like rentals for public storage. It provides extremely stable cash flow for decades to come.
And the second major catalyst is the thawing of the housing market itself. The existing home sales freeze over the past couple of years. That was a major headwind for storage.
Because moving is the #1 trigger for needing storage space.
The absolute number one.
Yeah. Our analysis suggests a gradual recovery and stabilization in the housing market in 2026 as mortgage rates stabilize. And that is going to unleash significant pent-up demand. The correlation is crystal clear. As that housing market activity unfreezes, public storage's occupancy is poised to rebound sharply.
So, based on all these fundamental shifts and catalysts, we developed our projections. In Scenario A, our base bull case, which we call the spring thaw, those LA emergency orders expire in mid-2026.
And that allows PSA to implement a catch-up rate increase program.
So what happens then?
When that regulatory cap is lifted, that $1.23 per share drag immediately reverses, effectively adding around $0.30 per share to their annual run rate cash flow.
And combined with that cleared supply vacuum we talked about,
We project a return to a healthy 20 times cash flow multiple on their realized FFO.
which puts our target price projection at around $360 per share in this base case.
Yeah.
It reflects both the structural improvements and that regulatory reversal. And we also analyze the counter scenario C, which we call the safe haven bid. If the economy enters a deeper recession and the Fed begins cutting rates aggressively, public storage's dividend, currently yielding around 4.6%, becomes extremely attractive.
Right, because this business holds up really well in a downturn.
It does. And the dividend provides substantial carry, meaning positive relative returns, even if the overall stock market draws down significantly. It becomes a port in the storm.
So what does this all mean for you, the listener? Our synthesis concludes that the market's current pessimism represents a classic contrarian signal. The stock is discounted, currently trading at a cash flow multiple of, roughly 16.9 times.
And that discount is due almost entirely to that temporary regulatory anomaly in LA and the general rotation out of defensive stocks that we've seen.
So the sell-off is rational but myopic.
Utterly myopic. It focuses intensely on these temporary policy delays rather than the structural margin expansion being achieved through their unmanned strategy and the guaranteed supply shortage that's coming in 2027.
So our final verdict, based on everything our research uncovered, is that we recommend investors accumulate shares at current levels.
The regulatory cap is finite. It will go away. But the operational improvements, the cognitive moat, and that supply vacuum tailwind, those are structural, and they are compounding over time.
Which brings us back to our title. We called our research The Fortress in the Fire for a reason. And that leaves you with a final thought to mull over.
What stands out to you about the fact that the time to buy the fortress is when it is surrounded by smoke, not when the sun is shining?